With stocks rallying towards all-time highs, what are bonds doing? Let's talk about that next. One of the big conundrums this year going forward is going to be the impact of inflation and tighter monetary policy on interest rates. Of course, higher interest rates have an impact on economic growth, also have a big impact on the financial markets because of the relationship between the risk-free asset rate versus equity valuations. Of course, with inflation rising, that suggests that we should see higher levels of interest rates pacing the sharp rise of inflation. That's actually been occurring as we've seen lately, and we talked about this previously. We did get a buy signal on yields. Now, buy signals on yields mean that bond prices go lower, yields go higher. That's what's been happening here. Bond prices have been declining. And really for the last few weeks, we've seen the interest rate on the 10-year Treasury rise. Yesterday, bond prices slumped fairly sharply as we saw about a 12 basis point jump in yields, getting up to 1.63% yesterday. Now, again, we're still well confined within this trading range that we've been in, and like the stock market, yields are starting to approach an overbought condition in the markets. Now, again, we've seen this very sharp rise in our indicators suggesting that yields would rise. That's been the case. We had reduced our bond exposure previously, anticipating this. Now that we're starting to get up these upper ends of the ranges, we're now starting to look for an opportunity to increase our bond exposure, our duration in our portfolios as well. Now remember, in our equity models, we run a 60-40 allocation. So we're about 60% stocks, 40% bonds and cash. Well, we control the duration, the risk in our portfolio by lengthening or shortening the duration of the bonds. So we had reduced our longer duration bonds previously, brought that in, raised some cash in the bond portfolio. That really shortened our duration here, lowered our risk to rising rates. We're now starting to look for the opportunity to put bonds back in the portfolio here, lengthen that duration for the next drawdown. Now, what does that mean? Yields are falling. We're probably going to be seeing a correction somewhere within the stock market. And again, that's not surprising here. Markets have done very well here over the last several months, but heading into this year with the Fed hiking rates, and more importantly, the Fed starting to taper their balance sheet, historically that leads to lower yields. So lower yields means obviously higher bond prices. So in our bond portfolio, we're now looking for that opportunity to increase our bond portfolio side. That'll provide some risk hedge to our equity risk in our portfolio, as well as give us the ability to capitalize on falling yields, rising bond prices in the weeks and months ahead. It's not quite time. We're not there just yet. This is not the time to start buying bonds, but we are starting to get into the range where historically we've seen peaks in yields previously and have had nice buying opportunities for bonds. So if you're looking for a way to hedge some risk in your portfolio, keep a watch on bonds. May really work out for you here over the next few months. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. See you back here tomorrow.